Directly from 42nd Street in Midtown Manhattan, New York, I am your host Harbin and you're watching my channel YOLO, You Only Live Once. Okay, let's talk about today's topic. What is multiple bucket strategy and how is it beneficial for you and how to save using multiple bucket strategy? I've seen a lot of videos regarding this, and they always talk about three bucket strategy. And then I started wondering why just three buckets, because you have buckets based on your tax status. Okay. Similarly, you have buckets based on investment risk, as well as buckets based on tax category. So if that is true, then how can you just have three buckets? So one thing to understand why you want to diversify your assets. As anyone basically says, there's a very good saying, don't put all your eggs in one basket. So similarly, don't actually have one set of investment asset bucket. Okay. So you have to have multiple buckets of investment accounts based on your tax status. That's the first goal. So when you start saving for your emergency, when you have started working and you want to basically build emergency saving for rainy days, you have to basically put all your asset in a taxable account, because whatever you are gaining profit income on that asset is basically taxed at an ordinary income. Now then, once you have built up couple of months of emergency fund, you should start looking to invest in a tax deferred account. A tax deferred account is a retirement account. It's a 401k, 403b, or individual retirement account. It allows you to basically invest or save money prior to Uncle Sam taking taxes on it. So before you have to pay taxes on it, if you put the money in an account, it becomes tax deferred because you have not paid taxes on it. Now the downfall of that is that when you will take the money out of that account in your retirement, you will be paying taxes on it. But you can actually have favorable taxes in retirement, and you basically consider, you always hope that while you are basically making money, you will be paying at a higher rate when you will be withdrawing in retirement. So that's why it's called a tax deferred account. You are not going to eliminate taxes, but you are just deferring the taxes. The third bucket is considered as a tax-free account. The tax-free account are the Roth IRAs. The Uncle Sam has given you such a good facility that it says you put your post-tax money in an account called Roth IRA, and then we will forget about paying taxes on that account. So that means you start putting money in your 20s, 30s, 40s, 50s, and then let it grow to whatever amount it can, and then when you start withdrawing, you never have to pay taxes on it. And the best part of it, if you basically pass that account to your next generation, they don't have to pay taxes on it either. So that's one of the best account you can save money in, but it is very difficult to basically save money in a Roth IRA because the limits are low. That means you won't be able to contribute if you make more than 200,000 to begin with, and if you are contributing to 401k, you might not be able to actually have an individual Roth IRA account also. But IRS also provide you a loophole. If you are a high earner and you have amount you can basically put in your post-tax 401k, you can convert that post-tax 401k into a Roth IRA. Please check my video on that particular subject in order to know how to best utilize that facilities from IRS to be able to convert your post-tax money into Roth IRA. That's the best way to basically create this bucket. The next set of buckets you can create is based on your investment risk. When you are in a 20s, 30s, and 40s, you basically just have one bucket, and that should be of high risk, high growth stocks. Okay, you should basically put in a high growth account assets. They will have higher risk. Basically, the volatility will be higher, but it is in your favor to grow your money as much as possible. So maximize your growth in those 20s, 30s, and 40s years when you have time on your side. You have 20 to 30 years on your side and make use of it. The other category in a bucket is in this category is medium risk. These are the mutual funds where you don't pick an individual stock. You have a mutual fund which invests in a diversified stock portfolio, in the sense diversified, not in the sense of like, okay, having bond and stock in that portfolio. You can still have a fully stock mutual fund, but since it is not relying on one single stock, you are actually reducing your risk. Your exposure to, suppose you just have all your money in Google, and Google basically dropped from $200 to $100 as it did this year, you actually lose half of your portfolio. But if you have this money in S&P 500 or NASDAQ 100 index fund, mutual fund, then your withdraw or your drop would have been 20 or 30% instead of 50%. So risk, having invested in one stock, is a high risk, high growth, high risk, while in investing in an index fund is a medium risk. Even though still risky, it's a medium risk. Now there are low risk investment like treasury bonds, your high yield saving accounts, where certificate of deposit, where you have risk, which is inflation risk. You can lose your money. You don't actually lose your money. The value of your money can go down if the inflation is very high and you are getting lower interest rate, but you will get the amount you were promised in that bucket. So that means you know how much money you are going to get irrespective of what the financial condition is going to be. So that's why it's a low risk asset. But now there's another set of buckets which is on the tax category, because all income when you are investing in a taxable account is not going to be taxed in the same way. So if something which is taxed as an ordinary income and you are actually on the high end of your taxable bracket, if your income is high to begin with and you are paying 37 or 39% of maximum IRS and you live in a high tax state like California or New York, you are actually paying more than 50% in taxes for any income you generate on top of your regular income. Okay, so then anything that comes out as an ordinary income will be taxed at the highest rate, and you actually lose most of that money. That's why you have a capital gains income. Okay, so then anything that is taxed as capital gains is a favorable investment for a person who is actually at the higher end of the tax brackets, because the capital gains will be either 15%, 20%, or the most 25% in certain scenarios with surcharges. But you still will pay much less than the 40% or 39% at the high end of the IRS. So that's why the tax category bucket is also very essential. The third bucket in this category is state and local tax exemption. Okay, so you can actually invest in treasury bonds whereby you can get exempt from state and local tax. If you're living in a high tax state like California and New York, that is a considerable saving on our taxes. That means around 10% to 13% in California or the higher, and in New York, if you stay in Manhattan, New York City, you actually pay New York taxes as well as local taxes, so which actually saves you around 12 13% to begin with. So the point here is that there is not just three buckets, there are actually multiple buckets, and you should take care of your investment to put your asset to work for you so that you maximize your return post tax and not just pre tax. So when you are in 20s, 30s and your 40s, your goal is to maximize growth of your portfolio. You are accumulating. So you want to basically invest in a high risk growth stocks. Okay. In that high risk growth stock, volatility will be high. Your portfolio will go up and down drastically, but you have to understand that stock market has not lost money in any 20-year period. So that means if I start today investing, okay, as I started, check my videos, I started investing in two portfolio, one for dividend, one for growth potential. If my time horizon for my growth potential is going to be 20 years, I am certain that I will not lose money on that account. So similarly, when you are in 20s, 30s and 50s and you are basically trying to accumulate growth, money, wealth, you should invest in high risk stocks, high growth stocks where your potential to actually grow your portfolio is higher, even though there is a downside risk. In a 20-year period, you will come out higher to begin with. The way to build that is, first you basically make sure you have cash for your emergency. So you have set aside taxable asset for your emergency, which is invested in a high yield saving account, or you can actually also invest in treasury bonds. Check my videos on high yield saving account or the treasury bond. I have a ladder, treasury bond ladder for $1 million in my taxable account, and you can check how actually I build it. Then you have a tax deferred high growth account portfolio in your retirement account. So tax deferred or the retirement account, after you have built up your emergency reserve, you should start investing in tax deferred account because you're saving taxes today. In 99.99% cases, whatever people tell you, you will be paying less taxes in your retirement on that 401k or individual retirement asset account than you will be paying today. And why is that? Lot of states don't tax the retirement withdrawal. Even a high tax state like New York basically does not tax first 20,000 every year from withdrawal from your retirement account. So there are a lot of states, they don't tax your social security. So you will be in a better tax environment if you are at the high end to begin with today. Okay. So there is no way you can say that if you are in a 37-39% bracket that you will be in a 37-39% bracket in your retirement. So it's always better to invest in tax deferred when you are actually making more money. And if possible, if you have additional reserve, check out my video how to create a Roth IRA account when you are earning high. When you are a high earner, you can still contribute to Roth IRA and create a Roth IRA portfolio. Check my video on my Roth IRA portfolio, and you will come to know how you can do it too. Then we talk about age-wise investing in the taxable account. In taxable account, in your 20s and 30s, you basically put it in a high growth and don't withdraw. Okay, so that means if you are putting all money in your capital, in your stocks, and you are not withdrawing, you are not getting tax on it. Okay, so why you want to basically create a taxable event unless you have to? So you are in your 20s, 30s, 40s, put it aside, buy stocks and hold it for long term. Okay, so even though if you have to sell it, you are basically going to get capital gains, taxes only. You should invest in a high growth because you have time on your side. In your 50s, you should start moving your asset, even in your taxable account, to medium risk. Okay, you can actually start creating dividend stock portfolio. So check my video on the dividend stock portfolio. You should still have some portion of it in the growth stock. Check my video on the growth stock portfolio I started creating now in my late 50s. And in your 60s and when you are in retirement, you should have a portfolio of passive income. So check my video how I am building my passive income portfolio. Okay, because you want to have passive income in retirement, because to replace your earned income in these years when you are working. So you have to have dividend stocks, treasury bonds, and cash, which might be in a high yield saving account, in a bank CDs or things. Now, what to do with your tax deferred account? A tax deferred account should be only growth oriented. It can be high risk growth or a medium risk growth depending on your tolerance of the risk. Okay, so you can put your 401k all tax deferred in a mutual funds or individual stock depending on your tolerance for the risk. But when you move to your 50s, you basically start to take a look at it and then try to diversify, basically mitigating the risk so that you don't end up losing all your value just before retirement. Okay, so you have to have fund in your retirement assets which you are going to withdraw from in your earlier year of retirement. So that means when you are going to be forced to take minimum required distribution from your retirement accounts, you should have money to basically withdraw from instead of selling your investment when the time is not favorable or the environment is not favorable for selling the stocks. So when you are in 60s and you are in retirement and you are in withdrawal mode from your tax deferred account, you should actually have 2 years of your withdrawal rate. Okay, so you should check my video on your retirement planning budget. Okay, if you have not done that, you should do it. Check the video, find out how to basically create budget for your retirement, which actually tells you how you are going to get funded in your retirement. Okay, so the point here is then you have 2 years of your cash flow in treasury bonds, short-term treasury bonds, so that you are withdrawing from it. Okay, and then you have 2 to 5 years in mutual fund. So that means it's a low risk, it's a medium risk account where your growth is still there, but you have still things under control in case the market tank. Then the rest of the money you still have should be in growth account if your horizon is more than 10 years. If the horizon is less than 10 years, or if you think that okay, you are actually in late 70s or 80s and you want to basically say that oh, I'm not worried about growth anymore, I want to make sure whatever I have actually lasts my years, so you should not even actually have the growth, high risk growth stock at that point. You should have most of them in treasury bonds or in low risk mutual funds. So now what is should be the strategy for your tax-free account? Now the tax-free account, as you know, are not going to be taxed, so you should basically have it in a high growth assets, because you want to maximize growth in that account. Only when you are nearing withdrawal from this account that you should move it to medium risk and treasury. When you are actually finalized that you are going to touch this account, want to withdraw from it, you should put it in treasury bonds. So if you look at it, the way you want to have these three type of accounts, and within the taxable account, why you want to basically have accounts that generate tax status based income, because you want to basically control how much tax you want to pay on it. So you should actually arrange it that way. So you have taxable assets, tax deferred assets, and tax free assets. And then you have tax you have investment risk assets, you have low risk, medium risk, and high risk. And then you have tax status asset, which are basically ordinary income, capital gains, and exempt income. So I hope things are clear with you. If you like the video and you want to know more about any topic you think will be helpful to you in retirement or preparing for retirement, leave a comment and I will try and discuss it with you. And it will be a good mutual benefit for both of us, and it will prepare us for our financially comfortable retirement. Please subscribe to my channel, like the video, leave a comment, and have a great